The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Matt Justice here to build a case study on Marriott. Marriott has been in a significant bullish uptrend for a very long time. Its short-term averages are up, intermediate averages are up, its long-term primary averages are up as well. It's a very consistent stock. It's got a very good cycle to it. And with the market sell-off last week, if we're going to call it that, with the market sell-off last week, this is an opportunity to maybe get into a really good stock that, or make some money as the stock is at a support level. And so I ran a scan in Mock Trader, basically found Marriott. It's called Stocks Bouncing Off the Rising 20-Day Moving Average. So what I'm looking at Marriott here is a little bit of a retracement back down into support. The last few times it's done this, we have had pops back up. Like I said, it's been a very consistent stock in that regard. So what I'm going to do is I'm going to build a case study. This is called a swing trade. A swing trade is where you basically buy a stock at a support level and you sell it at the next level of resistance. It's a pretty straightforward trade. We're not going to buy the stock though. We are going to buy the call option on the stock. So here, what I'm going to do is I'm going to prep the stock. Even though I'm going to buy a call option, I still want to prep the stock to know if I have a good reward to risk ratio. Well, if I buy the stock at its current price, somewhere around $65, and I put a stop loss right underneath this level of support, say right underneath $64, we're going to put it $63.75. We're going to have a $1.25 risk. So if we bought it at 65 and we sold it at 63.75 right underneath support, once again that's $1.25 of risk. Well, the question is, where are we going to target? Most of the time people will just target like in that level right there. I think that's a little bit of a mistake when you look at something as strong as Marriott. Something as strong as Marriott's been very consistent in terms of the last few movements up. And if you look at the last few movements up here, it goes from $58 up to $63. That's a $5 movement there, and then it goes from $61 up to $66. That's another $5 movement there. So if it maintains that degree of consistency, I'm going to give it a target into the $70 range because support right now is right at 65. And so you got a $5 return for a potential $1.25 risk. That technically is a very, very good trade. So now what we're going to do is we're going to pull up an option chain on Marriott and we're going to apply the rules for buying it. Now I expect to hold this trade right around 2 weeks. That doesn't mean I buy August options. We need to buy more time than that because time decay is that as fast as in August. And so I'm going to go out to a couple months out into October, and I'm going to look at the call options in October. On the left-hand side of the option chain, this is your call options. On the right-hand side, that's your put options. Down the middle here, that is what we call strike price. That is the right we have over the stock. So I'm going to look at buying the closest delta to 0.60, and I'm going to go ahead and look at that 62.5 call option. So I'm going to buy the stock. I'm going to buy the call option, the 62.5 call option. Each option is going to cost me right around $3.60, which is $360. We're going to trade 10 contracts here, which was total value in the trade would be $3,600. Now what we're going to do is we're going to pull up a risk graph on Marriott and kind of see what our reward to risk ratio would be if the stock does what we anticipate. So now and a risk graph is kind of like a calculator. We just kind of plug in what we're doing and it will tell us kind of what our profit loss would be at certain levels on the actual graph. So looking here, okay, we can expect 2 weeks of movement. So we got to decrease the time there, about 2 weeks. Right there. Now, volatility I'm not going to analyze right now. Now, if the stock goes down to where our stop loss at 63.75, we can lose right around $800 in the trade. So we're not willing to lose $3,600. We're just willing to lose about $800 in the trade. And if you don't want to lose $800, don't trade 10 contracts. One contract, you would only pay $360, and of the $360, you would be only risking $80. Everybody can make this trade. And then we're looking at the $70. At the $70, we have a profit potential of $4,100, which means we have over 100% return, right around 100 and what would that be? 110, 115% rate of return if it behaves what we expect it to do, and if it maintains that level of consistency. And so when we're seeing the market sell off the way it has, yeah, we're a little concerned about that, but we can't stop trading, guys. The market has been bullish for a very long time. Marriott has been really, really good for a very long time as well. And so I'm looking to take advantage of a good stock being at a support level. If I'm wrong, I'm wrong. I lose $800. So what? Go make 2 more trades, make it back up. And that's just the thing. But one very important point. If tomorrow I see Marriott go down at the open, I'm not making the trade. I am only making the trade if we have confirmation going back up. Matt Justice, hope you enjoyed the case study on Marriott, long call option on Marriott.
Get in the game. www.tackletrading.com